We have like Coinbase, Robinhood. Those guys tanked like 50% or so when they became public, and that's when it becomes interesting, right? When it's not VCs or private equity that depends your valuation, but it's the market, and the market, as I said, can be harsh sometimes.
Linas, thank you so much for joining. I really appreciate it. I've been following your work for many months, probably over a year actually, to be honest. And I've seen the explosive growth you've had over on LinkedIn, especially. I'm not too sure about Twitter and stuff. I'm not really on Twitter myself, but yeah, it's been good following a lot of your posts, man.
Yeah, hey there, and yeah, thanks for having me. Yeah, I appreciate the kind words. Yeah, so it's interesting times to be alive.
Yeah. How come, like, what was it really that's giving you that kind of crazy growth? Like, have you always just been like, like super consistent, or, you've been putting out a lot of information that I suppose a lot of people aren't doing? It's very unique in what you were doing for so long as well.
So that's a good question. So probably there's no direct and one-sided answer. So I think it's a mix of both. So obviously, there was quite a consistency. Again, I'm not sure when I really joined the platform as such when it comes to LinkedIn, but over the last like two maybe or 3 years, I've been pretty consistent, and yeah, mostly focusing on stuff that's interesting for me first, and then hopefully for the public, and it's been centered around technology and finance and maybe something related to that. So that's mostly it. Yeah, and I tend to really value the community that I have managed to build. So obviously trying to be responsive and reflective as much as possible, but sometimes it gets really difficult.
Yeah, of course. I remember I had this woman on my podcast called Amanda Slavin, like really interesting entrepreneur from the States. And she was saying like when you get to those kind of like influencer stage followings, like it's so unscalable because I suppose your fucking DMs are always filled up and you can't get back to people, and it doesn't necessarily work out like as well, but I suppose you just do what you can.
Yeah, and I mean, I think that one of the good examples, and I might have actually copied his strategy, was from Gary Vee when he said that he's been very consistent. Not sure about right now, but at least in a couple of years back, he was himself managing all the accounts, responding to people and just literally spending days and nights responding to people. Maybe I'm not spending that much, but yeah, it's all about the being transparent and being there for yourself. So I mean that's my strategy. Other people might have chosen something different, have assistants or something else, but yeah, I'm trying to be myself.
Yeah, it's cool because it's funny when I so I'm always been podcasting for like a year, super consistent, like similar to yourself on a lot of platforms. But people are always like comparing my strategy to Gary Vee. They were like, you're always like putting up all these posts and you're always responding to people, and I never actually knew what it was. And then I started like watching this stuff, and then I was like, wait, I actually should be doubling down on it, And obviously, like nowhere near your size yet, but like it's interesting though. What was your kind of background? So it's like, what was your background to really to get to where you are at the moment now? So you're with Flutterwave at the moment, but
Yeah.
like how's that transition been? Because like you're a young enough dude, you're definitely not exactly a country manager that I usually see. That someone that's like 50 years old.
Yeah. That's maybe that's changing because of the nature of fintech. Because
Yeah.
it's relatively fresh, although some of the disciplines and building blocks could be used from elsewhere. So actually, I actually began my journey, let's call it, in fintech already back in university. I studied economics and politics with major in economics, and already then I found finance subjects very interesting. And then I tried to follow more and more, take as many elective courses as there was possible when it comes to all things finance. And since then, somehow I caught attention of the new area of finance at the time, which probably wasn't that new, but it was still relatively fresh. So then I found fintech, and I began my actual, let's say, career in the traditional financial world with the banks, a small like investment bank, as well as big heavyweights like Western Union. And still my curiosity was starting to build. And yeah, then there was an opportunity for me to join relatively big and well-known fintech at the time, which is even bigger right now, called Paysera from the Baltics, from Lithuania. And that's where I really, dip my toes and fingers into the whole area of fintech as such. And since then, I never turned back. Only the maybe the roles, responsibilities, and maybe sector to some extent has changed. But my interest only grew, and maybe more and more verticals or subsectors started to come in. The crypto, blockchain, then BNPL, and now Web3 and DeFi and stuff like that. Yeah, so it only accumulated, and yeah, right now I am where I am.
Yeah, it's cool because like I was similar enough to you, like obviously like not the same like trajectory, but I remember I was in traditional finance too, and fintech was just kind of kicking off like 2016, 2017. I'd just heard of Revolut at the time where I work now, and I remember being in kind of like conferences in London, and I remember guys, traditional finance guys, saying like, oh, like all these kind of fintech firms are all going to die. They're not going to get the funding they need. They're not going to beat like the big banks, and some of them haven't beaten the big banks. That's fair to say. But they were saying like, it's kind of like a trend, and these trends come and go in finance, but it's going to kind of die down. So that was kind of my awakening. And then I remember hearing all these like really cool pitches, people solving like genuine problems. Like problem statement is, we can't send money back to a country, a home country. Remittance is the issue. Here is the solution. And I was like, oh, that's interesting. That's a cool development. And then finish university, and then kind of opportunities came up for myself like that. But what about yourself? Like, have you seen the kind of evolution that's kind of happened? And when you got your interest kind of spiked, like how has it kind of been for you, and what have you seen kind of change?
Yeah, that's a very good question. So actually, the interesting thing that you touched Revolut, which has pretty strong foothold here in Lithuania, and it actually got the first banking license out of here as well. And there was like many interesting and not that interesting stuff related to that. But what I do remember was although at the time I was also working at the fintech, as I said, but it wasn't that sexy, and there was a lot of confusion as well as maybe mistrust from traditional people, regular people, even businessmen. So they were constantly asking, so why should I trust you guys, even if you have, I don't know, faster onboarding, better pricing, and maybe some additional services, as opposed to my traditional bank, which I have been using for ages. I trust them. They have a track record, and I feel safe. And there was quite a battle, speaking with the customers or partners, trying to convince, also advocating about the protection of the funds, because there's a common argument, when you are with the bank, so 100K or equivalent in different countries is protected. So what about if you are with the EMI, which it's not a bank, etc., etc. So that was one transition, which is still obviously prevalent, because if you look globally, still majority of the clientele, wealth, you name it, is still controlled by the big banks or legacy players, irrespective of how you look at it. There might be some countries where fintechs have a bigger market share, but on aggregate, banks are still dominating. So there's still a lot of room for growth. And then there was another sentiment which you briefly touched upon, like so there's like companies like Revolut and 26. So what can they do? I mean, they're like fintechs. They have a nice car. So how big can they grow? 5-6 years passed, and we see how big they are. And right now, the big guys are trying to be more careful. They're trying to be more protective, and to some extent, they have copied quite a few strategies, which at the end of the day turn out a net positive for the consumers, because consumer is the one who wins because of more choices, better pricing, and more capabilities. So there's been quite a shift actually over the last 5 years, and even more so going to happen in the next 5.
Yeah, it's interesting because like as you said there, like B2C like products, like it's all about obviously the consumer, and that's why like the UX is so important, all the customer experience is so important. But trust is a really interesting area to dig into, because like before 2008, people trusted their money in the banks, and the collapse of the banks. And then if you looked at surveys, especially in Ireland, there was a lot of surveys done about like trust in banks, and there was a lot of distrust to them. And then the whole idea is like, okay, so we don't trust the banks, now we don't trust the neobanks because they're too small. It's like, who is the lesser of two evils, and that's why it's been cool to see like so much fintech companies kind of grow into that space and get a kind of more dominant name. And I suppose when you become a household name and really get to the stage whereby the average person, not someone like yourself who is ingrained in the industry, but the average person sees a company, trusts them, and then can actually work with them and maybe be their primary banking lender, but maybe not.
Yeah, absolutely. So as I said, and again, this is not probably my original quote, but trust is by far the most important factor in any relationship. Be it business, be it personal, you name it, right? So if you compromise it, it's very hard to get back to the point you can. And one of the probably biggest examples of that is obviously Facebook and all the issues that they had, and given their ambitions in traditional finance, in fintech, and right now in crypto, we see how big of an issue they have ended up. And right now, all the interesting stuff happening, with Meta, with DM, and stuff like that. It's not a coincidence. It was, it has been built up, and the same is, with maybe other players where you see, whether there was AML compliance issues, whether there were any fraud happening. So once you get to that point, it's very hard to get back, and then your growth potential, your scalability gets compromised in essence. So trust is crucial.
What's cool there as well is the fact you were saying about, like, when Meta or Facebook try to move into that kind of fintech space. So what a lot of people don't realize, especially with tech kind of startups, is like tech startups are kind of like the Wild West. They're building products. They could be building, let's say it's a podcast platform. They're building something, pretty much no regulation. But fintech comes with the fin side of it, the highly regulated financial element of it, which is obviously for good. Like that's a good thing, because it needs to be regulated. But as a result, you have people like Facebook move across and obviously get scrutinized heavily for when they were trying to launch their own crypto, because they probably didn't have the understanding at first. They thought you could come across. And funnily enough, I actually was speaking to a lot of not founders, but people that have joined fintech firms, and their founders are not originally from finance or from a close industry, and the guys are usually kind of missing the point. They could be from something that's like an Airbnb, and they think, oh, you just build it and people just come. But it's like, no. Like as you grow, like there's so many bells and whistles you have to get right.
Yeah, and the funny thing is that at my previous role, before joining Flutterwave, I was working in banking as a service field, which is or right now maybe you could call it even embedded finance. The names change, and it was at the time relatively hot vertical. Right now it's becoming even more hotter, and I also met quite a few people, potential founders or current founders, that wanted to do the next neobank, the next B2B proposition. And when you started to speak with them, they didn't really have an idea of how much time, effort, and obviously money it costs to build a neobank, right? It's not only having a fancy card or a great working app. There's a lot of building blocks that come beneath the surface that you don't see, but you have to make sure that they're all working in place. Because at the end of the day, if you don't have these, so either you would get screwed, or your partner gets screwed, which provides the technology, whether with or without licenses, or the customer gets screwed. And if the customer gets screwed, then either way, that might come back to you. So absolutely, I can definitely agree that there's a lot of misconception and misunderstanding, especially from non-financial background founders, which is not a prerequisite of not being able to scale, but it has definitely that point when they don't have a lot of knowledge before thinking very aggressively. Let's go like that.
Exactly. It's like anything, if you come from a place of having experience or some sort of subject matter expertise, it's obviously going to benefit you. So when you move into a new vertical, it's quite difficult. But that's funny you were saying that about, kind of founders, which kind of leads into kind of like the investment side of it. So it seems to me that like pretty much like everyone under the sun is getting investment these days. Like it seems like if you have a decent business model, and this kind of goes back to your point about a good idea, decent business model, obviously a revenue model built into that it seems a little bit more kind of loose. Like, so last year, just in the first half of the year, there was $11.75 billion raised, which is crazy. Like, so firstly, kind of what's your thoughts on that kind of approach at the moment? Do you think it's justified?
Yeah, so that's both good and difficult questions. So maybe one thing to to note, which I think is still misunderstood, or not misunderstood, but let's say forgotten. So right now, what we have seen and what relates to the last couple of years happening in startups is that there's a lot of celebration when it comes to new funding, new valuation, but that's all fine, right?
Yeah.
But I think we should celebrate more the founders who have managed to bootstrap the businesses, to make profitable them from day one, or actually do this up until the IPO or exit, whatever. That's actually the strength and what we should be proud of, right? And also, again, not sure who said that, but I shared it actually a couple of times that people should be focusing on making money, not raising money. Raising money is easy these days. Making money, that's the tricky part, right? And yeah, it comes back to the to what you mentioned, right? So there's a lot of capital. There's even excess of capital, which effectively led to the fact that virtually anyone was being able to raise money for probably anything, as long as you had the some rocket emojis in your presentation and some big growth potential. Bonus if you add crypto and blockchain, that's again going to get investors crazy. Yeah, but I mean that's not bad, because people are being able to actually to build businesses in real life, to get real experience, as opposed to going to the MBA or just doing project work at school, which at the end of the day leads to salary paid. I don't know how much it contributes to GDP, but lawyers get paid, accountants get paid, everybody gets paid. So at the end of the day, it's net positive. Obviously, a lot of them will get bust, but that human capital, it builds up. And at the end of the day, maybe not now, maybe not tomorrow, but after 5 years, maybe those people that got their startup to the wall will found something big. So I mean, I see this as a positive thing in general, but obviously it's not sustainable. It should end at some point in time, maybe not this year, but yeah, there's an interesting time to be alive in this explosive times.
Yeah, because like when you get the investment, it's only just begun. And there's a guy, Eddie Whittingham, who was on my podcast. Great guy, bootstrapped a SaaS business, sold it for 7 figures. Great fella. But he was saying like the biggest criticism is like a lot of these guys leave their jobs because they're like I don't want a boss. Fuck the boss. Then they leave, they get funding, and then they just have a new boss who just put money in their pocket. So it's like they're starting again. So like the work only begins at that point. However, with the influx of money, like that's generally what innovation is. It's the same as if it was a research paper. If it's Stanford or Harvard, if they're funding scientists or researchers, they obviously need that research, and they have that money. Whereas what would happen in an academic field is the fact that the money would be very tight in certain places, whereas in fintech and then other technology sectors as well, it's just been flowing, I suppose. So I suppose now the idea is like, if you do get it, you just got to capitalize on it and differentiate. But that's another actually interesting area, is like differentiation. So like we have a lot of firms now that are very, very similar. It's kind of hard to just really separate one from another. Do you think the space is kind of getting a bit too crowded?
That's a fair point, actually, and so and it actually comes down to some of the trends that we already have started to see last year and maybe a year ago as well, and that should continue this year as well. So it's obviously consolidation. So there should be more M&As coming into space. There have been some companies that were pretty aggressive in the acquisition space up till now. But more should come, especially from the probably bigger guys, be it in crypto or in fintech space, because you can be strong in one area or another, but we still don't have one like global super app or global fintech, whatever. So those guys having those ambitions, they obviously wouldn't be able to scale as they are. So I presume we might see something similar as we have seen with Uber, where they focus on where they are strong in, so primarily US and some parts of Europe, while the rest of the business where they try to scale aggressively, they either sold or exchanged in stakes with other companies. So good example would be China and Didi. I think shared yesterday in my newsletter that Uber is exiting. I think Uber Eats in Brazil, which again tells us something about potential path that other players, again in tech or fintech space, might follow. And yeah, so obviously, consolidation will happen both from fintech and from the banks. And yeah, as you said, the space is pretty crowded already. But again, as getting back to my initial point, the majority of the financial services pie, if I could call it like that, is still with the legacy players, right? So it comes to the uniqueness and value add of current or upcoming players that they could try to make a bigger impact. So yeah, that's my take.
Yeah, because like the market cap is literally there. There actually is an industry with a large proportion of people that can be essentially absorbed, but it's difficult. Uber was a good example there because, obviously Uber is like trying to get into every aspect of the entire world. And funnily enough, if you ever saw the Polymatter video on Uber in China, it's actually kind of comical. So they launched in China, didn't localize their application in anyway. They had like English translation in China, and they didn't really make those adjustments. So I think that's kind of some of the challenges for a lot of tech companies is like they're growing so fast because I suppose you're only investing in two things, which is growth, which is marketing, or your product. And then when you do launch and do try to get in those spaces, usually the local places kind of push you back out and they say, we don't want you, especially, and China's coming down really hard on these tech companies too.
Yeah, so I mean, I think that's a common thing. What we have seen in tech primarily, or what's called blitzscaling, where they prioritize growth about everything else, and of course it comes with a cost. But I mean, the rationale for that is pretty obvious. So the biggest challenge for companies that are in a growth space, and especially trying to make a market for them or tap into already penetrated market to some extent, is that there might come somebody else that might grow faster than them. So that's the key, right? And since they're focused on that, they are compromising one thing or another. If you are in the financial services, we often saw that companies are compromising compliance in KYC, and this is a very bad thing. And it at the end of the day, it gets back to them one way or another. But yeah, I mean, you have to trade off something for something if you want to reach your destination. It's not always a straightforward path, right? You have to compromise something, something bad for something not that bad.
Yeah. And a lot of it is profitability as well. Like they could stay within their current region and become profitable, but I suppose to get that global reach, you need to go through a certain period whereby you're hemorrhaging money, and that's kind of the model of all software platforms, SaaS platforms, and then a fintech, is that they go through these long periods whereby they're not profitable, but then overall, once they reach that kind of break-even point, then they're kind of in the green, really, aren't they?
Well, I think this is pretty debatable, and I have heard like quite a few companies who said that, okay, guys, so we are prioritizing growth, and we could be profitable from tomorrow if we, let's say, cut out growth. I'm not sure. Right?
Tell me.
I mean, it's not that simple, because I mean, the purpose of growth is that they have and know that they can raise money. If suddenly they wouldn't be able to raise money and they would really have to contribute on profitability, I don't think that would be like that straightforward and that easy, because at the end of the day, I would see it as going on a train. You go high speed and then you stop. How fast can you stop? How safely can you stop? It's not that easy, right? Then again, going to the same Uber, right? The same model which is being employed by dozens of others. Uber themselves, after getting the IPO and when the new CEO joined, they publicly said that they might not be profitable at all, never, because the operational cost that they have, they don't bring enough capital, right? The only way that they might be profitable if they would cut out all the human workforce and be running this on the autopilot. Again, that wouldn't be like from day one they just buy Teslas and get rid of the people. Again, it's not that simple, right? But still their stock is doing pretty okay. shareholders are happy, and as long as they have capital, they can say whatever they want, right? But it's not that easy and that straightforward. And again, you always should question when somebody says something, because usually they have some intentions behind, right? Being a CEO of a high growth fintech, which is like not profitable. I mean, of course that you say that, yeah, we can be profitable, but we are prioritizing growth. I mean, that's no brainer, right?
Yeah, it's interesting because like those people of influence have to have those perspectives. Like they can't come out and say, you know what, we may not be able to turn profitable forever. But that Uber example is hilarious because like isn't the number one purpose of businesses to make a profit? So if they're
Yeah.
growing so rapidly, and what's funny as well is I suppose, I've worked in a couple of startups now, and the smaller you go, usually the more manic it is in just terms of like, being able to understand metrics and profitability and forecasting and stuff, because like it's all kind of fugazi, isn't it? Like you don't know until you know. Maybe only likes of the top, tech companies are able to actually extrapolate and do a lot of scenario analysis. So it's funny because like you can say whatever you want, but to your point, until the results are actually there and you're public and the filings are actually public, you kind of can't take anything for granted, can you?
Yeah, exactly. And especially it becomes interesting when you get to the stage of the IPO, where it's not you or VCs that determine the value, but it's the market, right? And the market sometimes can be harsh. Again, reflecting to what I have shared yesterday on my newsletter, there was, and again, it was shared, I think earlier, about Wise. So, I mean, really successful fintech. I mean, profitable for like 4 years or so. I mean, doing amazing job. But there was an analyst from a bank who said that he doesn't see the growth potential as ambitious as Wise claims to be, and the shares like tanked 10% or 50%, right? But the underlying business is like pretty solid and pretty stable, right? We have like Coinbase, Robinhood. Those guys tanked like 50% or so when they became public, and that's when it becomes interesting, right? When it's not VCs or private equity that depends your valuation, but it's the market, and the market, as I said, can be harsh sometimes.
And on those IPOs, so like even other competitors, so all buy now pay later across Australia were down like it was like 80% last year in total towards the end. Robinhood, I think it was down like 56% or something by the end of the year. It's not even a bit more. I think I'm underrating that. But they seem to be just so volatile on the way down. Because a good example is Grab as well. Grab did a SPAC and then actually came out the other end, and it still got absolutely hammered. So I suppose, are they just a little bit more kind of vulnerable and a bit more kind of volatile as a result? And then you have example of Deliveroo, who just kind of got it wrong, listed on the London Stock Exchange, and Jesus, nearly died in the first day.
Yeah, I mean that's pretty tough. So again, I don't recall the exact data, but most of the IPOs that went public last year, they are performing below their initial public debit, which again begs some questions. What's the issue? But again, there might not be any issue at all. It's because many investors might not be that confident, which could be okay for the regular guys that might buy this at a discount. So it doesn't mean that Deliveroo is a bad company, or
Of course.
Wise is worse because some analysts think that the growth ambitions are not that possible to achieve. But I mean, this is where it really gets interesting, for me, because you can value the business as much as you want, but when it's open to the public, that's where where the real game begins. And again, there's a lot of interesting things happening right now, with the COVID, with the crypto coming, with the Fed changing its policy. So the stock market usually follows these kind of impulses, and unfortunately, fintech wasn't the most positive experience for the investors. But yeah, I'm still bullish.
Yeah, it's interesting there because like when like the market does kind of decouple from the economy, you saw like all those Nasdaq stocks just get absolutely hammered over the course of the last month or last 2 months. And I think overall, I think it would like some of them mid cap ones were down like 50% year over from last year, which is crazy, you know. So I suppose this year will be good from that perspective. And a few other guys that I podcast with recently, you know, they're saying like last year and the year before, like you're kind of, you know, you're back in the days of stock picking, it was fine. Whereas this year it could be completely different. So you're kind of looking into, you know, a crystal ball up until this point because everyone's just assuming. And I suppose, you know, investor sentiment is kind of low, but like, you know, ultimately there's no point trying to predict the future in that regard.
Yeah, absolutely. Yeah, absolutely.
So what I wanted to get into now as well was around that kind of crypto DeFi space, because I know you're quite interested in as well. What kind of excites you from a fintech perspective in that region?
That's a very difficult question actually. So maybe to put it pretty vaguely is I think the opportunities and the potential new ways of doing things that could be opened up. And one of the interesting things for me again is maybe on the capital accessibility or like credit, let's call it like that. So
Yep.
and this is especially acute for the emerging and developing countries, because one thing is, you know, for these companies it's kind of hard to access capital. If they
Yep.
do manage to do that, the interest rates are crazy, and in essence those guys already small, they're being ripped off, and it's very hard to grow, right? So with the help of like crypto or DeFi, whatever, blockchain, and different protocols, you could actually first increase the access and democratize it, and second, offer better conditions for financing. So that's one of the most interesting things in this kind of a regard. On another note, I don't think it's already a trend, but there's an interesting thing happening with DAOs already, and the way they are doing lots of different things. So
Sorry, can you explain that for people, and including myself, to be honest, because I do see a lot of it, but I don't really understand it. Not gonna lie to you.
yeah, so DAO is a like decentralized autonomous organization. So in essence, a company put on a blockchain and run on a smart contracts, to say like that. So if you have like a firm, so in very simple terms, like put it on Ethereum or any other blockchain platform. You know, I don't know, Solana. There's Avalanche and many others, and that's pretty much it. The company is being governed by the community, which, you know, hold, you know, tokens and usually have, you know, voting powers and determine the direction in which they are going. Of course, there are, you know, different phases. While there's like a fully DAO, when, you know, actually the community decides where and what to do in terms of, you know, development of the protocol, launching new services, whatever. And there's like semi DAOs or like pre DAOs, where there's actually like a founding team which runs everything and decides, but they have a plan. In like X years they would go fully DAO. And why this is interesting? So one thing that happened, I think, last week, when one of the DAO invested actually and backed another blockchain protocol in a Series A, I think, or even like a seed round, and that was up to 12 million, which, like, it's crazy amount of money. And this was done by a DAO, not a VC, not a certain private equity firm, but by a DAO, which in essence is a community.
Yeah.
And when you start thinking about that, that could potentially open up a lot of interesting opportunities for, you know, regular people. And you could think of that like, you know, so you create a protocol, whatever, Darren's DAO, and you invite hundreds of thousands of people to you know, to invest by the tokens, and you have a pool of I don't know, 100 million or so, and you could use that pool to invest in other potential startups by, in essence, you know, community governance, right? And that's how you as an individual, doesn't matter whether you have like $10, $100, or 10K, you could actually participate in the venture capital market, which is pretty much, you know, closed loop, and it's very hard to get. And not only you could participate, you could also, you know, increase competition and challenge the current market, which at the other side opens more opportunities for the startups themselves. So I mean, that's only positive. Of course, there are, you know, a lot of you know, compliance, KYC kind of things, regulations and stuff like that. But just from the capabilities perspective, that's very interesting, and that could be a very interesting shift happening in the next couple of years. Again, that's not trending.
Yeah.
I think I only know one company that done that,
Mhm.
but it sets an interesting precedent.
That's cool. What's kind of the advantage of doing that over crowdfunding then, apart from crowdfunding having the intermediary and so probably like a margin on that? What's kind of the advantage?
So when you do a crowdfunding, I mean, you rely on the third party, right? So it's the same like you would rely on on Facebook launching your marketplace, right? It's Facebook who actually controls everything, right? When you do this on DAO, you control everything. You have like the private keys, the public keys. You own what is yours.
Mhm.
At that point in time, there's an intermediary, right? And there are various obviously advantages and disadvantages, the same like you would have with Google as a centralized search engine, and there are
Mhm.
like others which are decentralized. Maybe there's a speed, but at the end of the day, it comes back to more of a philosophical change, which was brought by Bitcoin, that you should own your data, your asset, whatever. So that's the
Mhm.
key thing.
Yeah, I agree. Yeah, because like my perspective on this as well is that like I think that kind of decentralized approach is good, and I'm coming from a perspective of someone who's been cut off Instagram twice. Would you believe? Two accounts deleted, right? And I know a lot of friends as well. That's something similar. I wasn't doing anything bad, but what I'm trying to allude to is the fact that like when you go fully decentralized or fully like uncensored, whatever, it can often open things up to a lot of you know bad things then as well at the same time. So is there kind of like a happy medium there to be achieved, whereby we don't have absolutely free reign? I'll give you a good example like of something like so that platform Getter that everyone was talking about, that had Joe Rogan go over and a few other kind of decentralized platforms. They were ultimately like led to have like a lot of just crazy shit on them, really really crazy content and stuff like that. And then they were saying, okay, maybe we don't want to go fully down the road. So I'm comparing this to a kind of finance scenario whereby we're raising money and we have it up to everybody on the internet. Is there some sort of kind of like red flag there to be aware of?
I mean, yeah, of course. So it doesn't come without the risk, obviously. I mean, especially, I think the key thing here to understand is that this is a relatively new space, one of the
Mhm.
new frontiers in finance, probably going somewhat similar in the space of NFTs and DeFi in general, or Web3 better. So we had a lot of different examples where DAOs or protocols promising good returns, they just like did the rug pull and vanished. So there's always a risk, but
Mhm.
if you have a good idea, which is like a not something crazy, but it's actually doable, achievable, and it has real underlying value. You have a solid team, potentially even some backing. Again, the same VCs could back you right in the beginning. It doesn't really matter, but the key idea here is not to give the full control.
Mhm.
If you have that in place and you are able to decentralize that in a rational and simple manner to some extent, the risks are minimized. But given again, getting back to my initial point, as this is relatively new, many people themselves that are doing or launching these kind of projects, they don't really know and fully understand everything, and that's where the issues might come. And
Mhm.
again, I'm not an IT or engineer guy, but the one of the key things or challenges when it comes to all things blockchain is that there are transactions or contracts or underlying code that sometimes cannot be like erased. When you do something, that's done. I mean, the good example is Bitcoin, right?
Yeah.
If you send it to the wrong address, that's it. I mean, you cannot call a bank or a Visa and say, hey guys, I got scammed, please return my money back. I mean, nobody will do that. So, sorry, no sorry.
Yeah, it's crazy, I suppose, and that's the thing with Trojan technology. It's the first time, and there's so much things like open to interpretation, but that's also the opportunity. It goes back to the innovation element of fintech. Is like, if you don't do it, then it's going to be the same as always. One area I wanted to finish up on, really was around kind of Web3. So, you may or may not be aware of a guy called Thibaut Lorne. He's a French dude. He was on my podcast during the week. the dude is building a universe in the metaverse. Universe in the metaverse, yeah. So he's essentially building digital land. The guy built 50 apartments, 20 like shopping malls, all these different villas, and like he's getting a first kind of mover on the sandbox, kind of like space really. And I thought it was pretty cool. Had a lot of debates and stuff, but from your perspective, like what's your kind of take on where this is kind of going?
Oh, so that's I don't even know how to reflect that. On one side, I mean, yeah, obviously that's okay. We have games. We used to play games for ages now. We could experience that on a whole another level. But apart from all this, bliss and hype, I think there are a lot of issues.
Yeah.
Because and I think even like yesterday, I saw like what was it, like a headline on our post where somebody's developing something where you could like have some sort of a gadget on your arm and feel things in the metaverse. So why just you can't go inside and like feel real things? Why you need to go to the metaverse? I mean, we have already spent a lot of time working from home, living, being with our families in our closed apartments. We should focus more on spending time outside, especially with this whole global warming kind of thing, where things that we have right now might no longer be prevalent in the next 5 years, as opposed to trying to build some fictional world where all our fantasies could be fulfilled. I think that's the issue, and the key thing is probably comes to psychology and potential future of our kids. How our kids might be a normal, well-functioning human beings if all they do, or majority of the time they do, will, instead of playing video games where you at least are like in your real world in your apartment, you would be spending in the virtual world, in the metaverse, like buying some, I don't know, like fake, not fake, but NFT like t-shirts, whatever, glasses. I mean, that's pretty crazy.
Yeah.
That's pretty crazy, right? And people are not. Very few people are talking about the risk. They're all thinking about the potential. People going to the metaverse. So okay, I'm Nike, I'm Adidas. I need to advertise for people there. I'm I don't know, Joe Rogan. I need to do a podcast in the metaverse, something like that. I mean, that's fine, but what about the risk and trade-offs that we are I don't know, saying goodbye to? What about the real connection of the human touch, the actual conversations? That's what worries me.
Yeah, I'm kind of pretty much similar. I think like the kind of dystopia element of it is something to be very, very, very cognizant of. And I'll give you a perfect example. Like, so people who spend all day on Instagram, guys, girls, they could have 5K, 10K followers. They spend all day on Instagram. They're one, trying to grow their own platform, get as much social status and validation. And then on the opposite side, then they also want to keep up to date. And then they feel, intoxicated by looking at everyone else. I could be looking at your stuff and think, oh fuck, I wish I was that size account. I wish I had that influence, and it can degrade your mind. So you take that, you throw like lighter fluid on it, you bring it into the metaverse, and then it can potentially make things 10 times worse. Now there is an opportunity to make something that's, I don't know, improve an experience and do something better, but there's definitely things to be aware of. And I always think about not the rational, I always think about the irrational person who could abuse it. It's just like anything, like there's been a lot of studies done by, to do with alcohol, to do with drugs, and it's not necessarily the actual substance. It's actually the individual who could be a little bit more susceptible towards that actual element. So that's kind of what I'm kind of thinking is like, if you were a little bit more inclined to be addicted by something, you could hop on the metaverse and just fly down that dark hole, really, couldn't you?
Yeah, and I mean, as you said, so and again, not sure how global this is, but yesterday I was listening to the news, and people that are raising kids at home, they said that their kids are suffering from depression. They're feeling anxious. They're not the same because they spend so many times, so much hours, and with their parents in an apartment or in a house, as opposed to you just playing with their friends, socializing, that they are traumatized. And imagine the same being done in the metaverse, as you said. So you might have like Chanel's T-shirt, and I don't have it, right? My parents are not that rich. Of course, I would feel bad, especially in the when I'm kid, right? So, and I mean, that's pretty terrifying, right? But at the end of the day, people right now, especially the VCs who are especially excited, they are only focused on the upside. Nobody's really thinking about the downside, and that's the risk.
Yeah, and that's from the investor perspective as well, which essentially is not correlated towards the actual like human element of it. And that's the last question I have for you: is like from an investor perspective and from a fintech side, what do you think is the quote unquote opportunity for these companies? Do you think they're going to be developing, I don't know, payment infrastructure, NFT payment infrastructure? Is there possibility or something like that?
You mean for the metaverse, or
Yeah, for the metaverse. So if someone was to come in and build their own, let's say, like payment infrastructure or something like
that? I mean, that's I never thought about it like that. I mean, that's interesting. So yeah, obviously there should be some sort of a payment element built in, but that should be pretty much simple. And I would think of it as we have in just like regular games, like what do we have? I don't know. I'm not that much of a game player. I don't know. NBA to buy like a new pair of shoes, right? So so that's pretty much simple, because it's like an in-game transaction and there's barely moving any funds. What could be an opportunity again is just to add a payment layer on top of the underlying I don't know, maybe protocol in this case, but that shouldn't be more difficult than what we have today. So there are a lot of companies that are focusing on crypto on and off ramps, and that I think pretty much should be enough in to connect this space. Unless again I don't understand something, but yeah, that you got me pretty unprepared for this one.
No, don't worry. I'm just trying to think through different scenarios, and there will be something built for sure that's going to come up that's going to surprise us. But Linas, I want to say thank you and wrap up here. Now, I really appreciate it, and you have a wealth of experience and knowledge in this area, so it's been cool to sit down with you, man. I appreciate it.
Thanks, Darren. Really enjoyed the chat.
And where can people find you, just to wrap up on?
Yeah, sure. So the best way to find me is obviously on LinkedIn. You would find me by my name and surname. I'm also on Twitter and Instagram, but not that active yet. Not sure. Maybe I will become more active. But yeah, LinkedIn is the best way to go. And yeah, we can take from there.
Legend. Thanks, man.